Hello everyone, it's me PM Farouk. Welcome to Law of Money. Today we are going to learn important trading terms and types of banks. So let's start. Trading positions. Alright everyone, now let's talk about trading position. This is basically how traders try to make money from price movements. First is long position. A long position simply means buying a stock because you believe the price will go up. For example, imagine you buy a stock for 100 rupees. If the price goes to 120, you sell it and make a 20 rupee profit. So in simple words, buy low, sell high. This is the most common strategy in stock market. Good investors don't just buy randomly. They usually check company fundamentals, news and market trends during buying. Now let's talk about the short position. This is opposite idea. Here a trader sells first because they believe the price will fall. For example, if someone sells a stock at 100 and later buys it back at 80 rupees, they make a 20 rupee profit. Yes, it sounds strange. Selling something before buying feels like ordering desserts before dinner, but in trading it actually works. However, short selling is riskier because if the price goes up instead of down, losses can increase quickly. So beginners usually start with long position before trying short position. At the end of the day, traders use these positions as strategies to profit from market movements. But remember a golden rule of the stock market: don't trade based on emotions. If you panic every time the price moves, the market will give you a free lesson and take your money as a tuition fees. Volatility and liquidity. Now let's understand two very important concepts in stock market: volatility and liquidity. First is volatility. Volatility simply measures how fast and how much a stock price moves. If a stock price jumps up and down quickly, it has high volatility. For example, a stock moving from 100 to 20 to 90 in a short time is a very volatile stock. Traders sometimes like volatile stocks because there are more opportunity to make profit, but there is also more risk. Think of volatility like a riding a roller coaster. Some people love the thrill, others just want to get off safely. So beginners should be careful with the very volatile stocks. Now let us talk about liquidity. Liquidity means how easily a stock can be bought or sold. If a stock has many buyers and sellers, it has high liquidity. This is good because you can quickly enter or exit a trade without affecting the price too much. Large companies usually have higher liquidity because many people trade them every day. A helpful tip for beginners: try to trade stocks with a good liquidity. It reduces risk and makes trading smoother. Imagine trying to sell a rare item with no buyers. You might be stuck holding it for a long time. Stocks can feel the same way if liquidity is low. Remember, volatility tells us how much price movements move. Liquidity tells how easily we can trade. Understand this too helps traders make smarter decisions in the market. Average and charts. Now let's talk about average and charts. Two very important tools in the stock market. First, average. Average help us understand the general direction of the price movement. Think of it like checking the weather forecast. If the temperature is slowly increasing every day, you know summer is coming. In the same way, if the average price of a stock is moving up, it usually means the trend is going upward. But remember one thing: average is like your friend who gives you general advice, not exact instructions. It tells your direction but not the exact movement to buy or sell. Now let's talk about charts. Charts are simply visual representation of price movements over time. Instead of reading boring numbers, we look at charts and understand the story instantly. Traders use charts to identify trends and patterns. Think of chart like a fitness tracker. If you steps graph goes up every day, you know you are becoming healthier. If stock charts keeps going up, traders starts getting excited. But here's a tip: never trust a charts based on just one candle or one day candle. Always look at bigger time frame to understand the real trend. Volume and OHLC. Next we have volume and OHLC. Let's start with volume. Volume simply means the number of shares bought and sold during a period. Imagine a vegetable market. If only two people are buying tomatoes, the market is quiet. But if hundreds of people are fighting to buy tomatoes, you know something interesting is happening. That's exactly what high volume means in stock market. Strong market activity. When price moves with a high volume, traders buy more attention because it shows real interest from buyers or sellers. Now let's talk about OHLC. OHLC represents four important price in a trading period. O represents open price. This is price when the market starts trading for the day. H represents highest price, the highest price the stock reached during that period. L lowest price, the lowest price reached during that time. C close price, the final price when the market closes. Think of it like a cricket match summary. Open is like start of the innings, high is the best movement, low is the tough movement, and close is the final score of the day. Traders study this value to understand what happens during the trading sections. Types of banks. Now let's move to types of bank. First is central bank. The central bank controls the country's money supply and banking system. In India, the role is played by the Reserve Bank of India. You can think of central bank as the captain of financial team. It decides things like interest rate and regulates other banks. Next are full service banks. These are the banks most people use daily. They provide services like loans, deposits, and payments. So when you open a savings account, take a loan, or use online banking, you are dealing with a full service bank. Finally, we have Universal Bank. Universal Bank offers a wide range of financial services, including investment banking. This means they not only handle regular banking services but also work in the financial market. You can think of them as the all-in-one supermarket of banking, everything under one roof. This is the end of this video. We had talked about important trading terms and types of banks. Thank you for watching. Stay tuned for next video on Saturday 6:30 p.m. Bye.